On a Saturday in 1989, a famous investor received a phone call from arguably the best investor in the world, Warren Buffett, who wanted to ask him for a favor. And the question Buffett asked him during this call should change everything and reinforce a lesson that Buffett had already learned earlier in his investing career. And that's exactly what we will talk about in this video. What exactly was Buffett asking his fellow investor, and what can you learn from this mental model? So without further ado, let's get started. Alright, hey there! So the investing guru that received a phone call from Buffett in 1989. That's Peter Lynch, who became famous for posting amazing returns with his Fidelity Magellan fund, growing its assets from less than $100 million to $13 billion. Between 1977 and 1990, Peter Lynch averaged an annual return of 29.2%, which was more than double the S&P 500 return, making his fund the best performing mutual fund in the world. And so it should come as no surprise that Warren Buffett has a lot of respect for Peter Lynch. Which brings us to the aforementioned phone call. During an interview in 2017, Peter Lynch shared an anecdote and remembered how Warren Buffett once called him to ask whether he could use one of the concepts, one of the frameworks that Peter Lynch shared in his famous book, One Up on Wall Street, in his yearly Berkshire Hathaway shareholder letter. And of course, Peter Lynch agreed. And so let me just read to you what exactly Buffett then wrote in the 1989 Berkshire letter. In fact, when we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever. We're just the opposite of those who hurry to sell and book profits when companies perform well, but who tenaciously hang on to businesses that disappoint. Peter Lynch aptly likened such behavior to cutting the flowers and watering the weeds. Peter Lynch coined the term 10-bagger for stocks that grow 10x over the holding period. So Lynch is most certainly the type of investor that looks for long-term compounders, and he's willing to patiently wait for these investments to turn out successfully. And Buffett obviously transitioned to this investing style as well. So the mental model that I want to discuss with you in today's video in more detail is the idea that selling your winners and holding your losers is like cutting the flowers and watering the weeds. I recently listened to a great podcast episode of the Value Hive podcast. In it, Christian Reither from Curing Capital talked about how this Peter Lynch framework could be turned into a two-dimensional matrix. Basically, you have two dimensions: stock price performance and operating performance. And a company can be considered a weed when the operating performance is disappointing. So for instance, if the debt level keeps rising, maybe revenue is declining, or another business-specific KPI, like for example, the number of subscriptions for subscription businesses, maybe this number is trending downward as well. If on the other hand, the operating performance is outright excellent, all the important business metrics are developing in a positive way, trending upwards, like for example, revenue is growing at an above average rate, well then we are dealing with a flower of flowers. Now, based on this distinction, we may make different decisions when it comes to the businesses that we hold in our portfolio. Generally speaking, you always have three options. You can buy more of a stock that you already own, you can do nothing and just keep holding the stock, or you can sell it. Now, according to this framework, you want to be cutting the weeds. So what that means is that you don't want to tie up capital in stocks that are not performing well on the operating level. So we can clearly color these first two quadrants in red. And just to be clear here, even if the stock price is declining and declining rapidly, you don't want to invest in these businesses according to Lynch and Buffett. So that's this quadrant right here. Those types of businesses are sometimes referred to as melting ice cubes. Of course, an investor might believe that the market is pricing in a faster melting rate than he or she assumes, and hence there might be an investment opportunity. But this is not the game you want to be playing according to this mental model, because these businesses are simply not compounding machines. they are no flowers. What I also want to point out when we are talking about this quadrant is that it can be mentally and emotionally challenging to sell your stock at a loss. Say the stock is down 20, 30 or 40% from your purchasing price. But if the operating performance is poor, the business hit a roadblock, you should absolutely be cutting that weed and be quite ruthless in that process. That's the right thing to do if you are a quality-focused investor. Christopher Beck, Chief Investment Officer at East Coast Asset Management. He once wrote, "Many of our mistakes have been where we thought we bought something with a significant margin of safety, while knowing that it might be a melting ice cube. We thought it might weaken, but not for a long time out. But then it accelerated a lot faster than we thought it would. That's one of the big lessons we've learned over the last 5 years." On the other hand, you've got a flower when the operating performance is very positive. Now, first and foremost, according to Buffett and Lynch, you don't want to sell flowers. But let's take a look at our metrics again. Clearly, when the operating performance keeps developing positively, but the stock price declines significantly, you might have an opportunity to add to your position. On the other hand, if the company keeps growing, but the stock price reflects this improvement as well, you definitely might want to add to your position if management keeps executing on their promises. And again, this too can be emotionally challenging as you buy more shares at a higher price and thus increase your overall cost basis. And it's one of our mental flaws to be anchored to a lower price that we have paid previously. But this quadrant in our metrics certainly needs to be considered more carefully and in a nuanced way, because you definitely want to think about how the share price developed relative to how the intrinsic value developed. If intrinsic value grew quickly and is not fully reflected in the share price, well then of course you might have an opportunity. But on the other hand, the share price might already more than reflect the great operating results, and then you might decide to do nothing and wait for a pullback in the stock price. Okay, mental frameworks like this try to simplify things to clarify your thinking. But as always, there are no hard and fast rules in investing. And so what I want to do next is I want to highlight 3 more nuances that are super important to understand. So if you want to really learn something today, please stay tuned. First, there are instances in which you want to sell flowers. If the development of the stock price becomes so detached from the intrinsic value of the business, even though intrinsic value went up, then you might need to sell the business. Again, even though the development was wonderful. Keep in mind that the more a share price exceeds your intrinsic value estimate, the lower your future expected return. A good example of this may be Tesla. Now, if you follow this channel for some time, you will know that I'm not a big fan of Tesla. I don't think it's a super high quality business. And in fact, I believe Tesla is competing in a structurally unattractive industry. But there is no denying that Tesla has shown a very impressive development over the years on a fundamental level. Over the past 8 years, for example, revenue increased almost 20-fold. But ever since 2020, I think investors will have a hard time justifying the stock's share price development with any discounted cash flow or intrinsic value analysis. Of course, selling your winners can also be emotionally challenging because the stock has rewarded you for so long. But that's what a good investor has to do. A good investor has to make tough decisions, and he or she needs not to be deceived by his or her emotions. Secondly, I think when assessing whether a business is a flower or a weed, it is important to consider the time frame as well. Because even the best businesses in the world, they will experience short-term hiccups. That's why you should not immediately sell a stock when it disappoints during 1 or 2 quarters. And therefore, I noted down long-term operating performance in our metrics. And then thirdly, a business may be performing well on the operating level and the share price might not fully reflect that, but you might still not want to add to your position. And that's because a certain level of diversification makes sense. Maybe the position is already quite large and has reached your maximum position size, considering the cost basis as well. And I think it's always important or helpful to remain humble and to keep in mind that your analysis and interpretation of the operating performance and also your future outlook may be wrong. So limiting your position size to a certain threshold in a way acts as a margin of safety as well. Now, at the beginning of the video, I used the term 10 bagger. If you want to learn more about 10 and 100 baggers, I recommend you watch the following video next.